Geoff Garbacz. Welcome back to Money Life. And the thing is, anybody who's got quant in their name, I always say, I love talking to quant guys because when you have to ask them a question, that's kind of a question we ask in the market call, like, what's your favorite stock? They typically come back and go, I don't have one, but the system tells me or the computer tells me I like this. You need a market to move a little bit with somebody who's got a quantitative approach because you want to see the quantitative stuff changing. So let's start out with an explanation of how it works for you, what goes into your buys and sells, and then that side that says, what are you looking for as well in terms of big, broad conditions to make it that this is where we're feeling comfortable or uncomfortable broadly with stocks and bonds generally.
Yeah, so we have a very unique process in that we start out with the technicals first before we go to the fundamentals. So what we have spent our time doing is basically working with a guy out of Massachusetts named Phil Erlanger, who used to be at Fidelity. And so what we do is we look at short interest and options and then a technical rank to come up with our overall ranking on a stock. So as an example, a stock that we like might be strong technically, so it's outperforming the S&P, and it might have high shorts in it, and traditionally the shorts lose money, and then it also might have high put activity. So that's the type of stock that we might like, and then from there we go to doing our fundamental quant, which is built by a guy out of Indiana who actually created the Schwab rating models for Schwab, but now he's got another model out called Downside Risk Alert. So we love to combine the technicals with the fundamentals. And then we also do a lot of macro work ourselves to try and figure out what's going on with stocks. It's a three-part process. You know, a key thing that we do, Chuck, which I don't think we were doing the last time, but we put out a morning note as well. And that morning note is a free note. It's very in-depth. So it gives us a lot of knowledge about everything that's kind of happening in the market. And it's actually on Substack, and people can sign up for free. It's just quantpartners.substack.com. So are you familiar with Substack at all?
I am, and we'll have a link there for the audience as well if they want to find it on our guest page. But it is just quantpartners.substack.com.
And so most of our clients, it's kind of interesting, are clients of other people's. Most of our clients are financial advisors, registered investment advisors, hedge fund, mutual fund managers, state pension funds, and those are our clients. So we're providing advice to them, and then they're turning around and using our research to help them manage other people's portfolios. Although we kind of have entered something also in the last year. We're working with the Brothers Nigerian. What we're doing with them now is we are providing recommendations on stocks that are either short squeezes or long squeezes, but then we figure out what option to use and play. Kind of a really, really fun thing to do because the leverage you can get out of a short squeeze on a stock is pretty impressive. I'll give you an example. Back in December when we started this off, we recommended to buy Boeing. Then we actually recommended an option on Boeing, and the call option on Boeing went up 61.75%. The Boeing stock itself went up about 5%. So obviously, if you know how to use options correctly, you can get some really nice leverage out of that. And that's what they've been doing. They have a slogan, which is, it's just not an option. So in other words, you got to be using options if you want to enhance your returns.
Well, let's talk about where you think the market is, because as you pointed out, you've got a technical overlay first, but you also have a macro overlay. Economically speaking, well, if you and I spoke almost a year ago, we're still seeing a lot of things that make this economy look very solid, but there's a lot of headline risk. Headline risk is not necessarily something on the technicals. So right now, do you see this market having more upside room or downside room? And how much is the big picture kind of weighing on everything?
I think we're at an interesting point in time. Number one, we've got Trump back in. Now, the good thing about that is we know what he was like during his first term and how he impacted the market. Having said that, we've already started to see in the first couple of weeks of his term, the old Donald stuff that would come up and all of a sudden the market would make a sudden turn. So we're starting to see a little bit of that play out. The bigger deal, though, is if we look at the action the last 2 years. So we had a bear market in 2022. And when we ended that bear market up until now, through the end of this year, we're up 64.15% on the S&P. And since 1980, we've had 7 bull phases and then 7 bear phases as well. And what's interesting is the average move to the upside in those 7 periods since 1980 has been 156.75% in the last 5.43 years. So right now, we're only 2 years into it, and we're only up 64%, which means potentially this thing has another 3.5 years to go. And we've got another 92% upside potentially just to be average, which I don't think a lot of people realize. If you look at the single best period was 2009 through 2020, and that was post-financial crisis into the pandemic. The S&P went up 339.51% during that period, lasted 11 years. The next biggest one was 94 to 2000. That was 215%. So I'm pretty positive on stuff, although there's certain places where things have gotten really extended, so to speak. I mean, obviously the Mag 7, which I actually call Magnet now, some of those names are really, really gone up a huge amount, and I'm not so sure how much more they have, whereas small cap has kind of lagged. So I think this year will be a little tricky, and it's going to be a case of really following the bouncing ball, so to speak.
Well, let's dig in and talk about a name or two that really is the poster child for where you want to be right now.
I am a fan right now of Google. I really like Google a lot. It's not incredibly overvalued. It's got shorts in it, which is amazing that shorts would make a bet against it. It's in the chip business. It's in the media business. They own YouTube. It's just a great stock. It's like a stock that you can own and hold on to, and it hasn't had quite the return that some of the other MAGA names have had in the last year, like a Meta or an NVIDIA. So I think you almost have to own some of the magnet stocks, which is what I call them. So let's tell everyone what magnet stocks are. Microsoft and Meta, which is the old Facebook. And then for the A's, we have Apple and Amazon. And then for the N, we have Netflix and NVIDIA. And then the G is Google, the two Googles. Google actually has a Class A and a Class B. I prefer the Class A, which is GOOGL. And then the T is Tesla. So that group of stocks, you want to make sure you own probably at least 2 or 3 of them throughout time. So I do like Google. The other name that's really interesting is Microsoft here because it's gotten sideways for the last year now. It's traded between a range of 400 and 450, and it's kind of coming up towards the upper end of its range. And as a matter of fact, we'll know tomorrow because it's going to report earnings today after the close. We got Meta reporting as well and Tesla also. So some of these magnet stocks are coming out with earnings, but I don't think you can go wrong owning Google right now.
Well, now we're going to get your quick and dirty take on some stocks that my audience is particularly interested in.
Quick and dirty.
What? Terrific. We're colossal. We're even mediocre.
We're better than mediocre. We are terrific and colossal. And we're talking with Geoff Garbacz. He is with Quantitative Partners. If you want to learn more about the firm, quantpartners.com. Again, for their Substack in the free newsletter, quantpartners.substack.com. Quick and dirty is our lightning round. You know how it works. So we're going to jump straight in and we're going to go from some of the big magnet stocks, as Geoff was calling them, to one of the biggest retailers. Les in San Diego wants to know about Walmart. It is WMT.
Walmart is clearly they and Costco are the 2 biggest retailers, and Walmart's been doing great. The stock has plugged away. It's had a good year. You know, it started out last year at roughly $55, and now it's almost up at 100. It's trading at 97 right now. It's going to clear 100 and continue its march onward and upward. They're doing a lot of really good stuff in India as well. And obviously, fundamentally, it's a good company. And then in our work, the shorts had been in it. They kind of got out a little bit, but they'll come back to it again. In the last year, they've kind of come back in and out of it like 3 or 4 times. So I expect that they will continue to try and play it again, especially if we get any weakness on the economy. But so far, Walmart has been executing basically almost flawlessly, doing a great job.
Woo! Somebody done been to the Walmart.
That's a buy on WMT, Walmart. Tom in Smithfield, Kentucky wants to know about Jack in the Box. It's ticker Jack.
Jack in the Box. Well, today's an interesting day because Brinker, which owns Chili's, put up incredibly good, strong numbers. It's up $23, up from 154 to 177 today, up 15%. So that says to me, if you're a restaurateur and you can do some of the promotional stuff, it gets kind of interesting. And Jack in the Box has come down from $90 to $40. It's kind of basing. And the shorts have come climbing back into it, even if after it's had that much of a drop. So I kind of feel like they're going to get caught. They got to be thinking about this name after what happened with Brinker today. So I like Jack in the Box as a play for people that don't want to spend the $25 lunch. It's definitely an interesting idea. If we look at the fundamental side of it, it's only got a PE of 6.5, and it's going to go from losing $1.97 to making $5.94 in the next year. I don't know exactly what the turnaround is, but there's a big turnaround going on at Jack in the Box, and I like this as is what I call a bottom fisher. It's a bottom fisher play.
Cheeseburger in paradise.
In this case, the cheeseburger in paradise is coming from Jack in the Box. I'm not sure that makes it paradise, but it does make the stock, JACK, a buy. Lance in Bethlehem, Pennsylvania wants to know about Adobe, ADBE.
Adobe, unfortunately, has really struggled compared to a lot of the other mega cap tech names. In the last year, it's gone from over $600 down to bottoming at $400. It's at $442 right now. And the shorts are in it, and the shorts have actually done a decent job in the last year on it. So this is one I'm not a fan of. I'd kind of stay away from it. I know lots of people recommend it because it's done well over time, but lately they're just not executing well. I think they're having some issues as we transition into different platforms to read stuff. So I got to be a thumbs down on Adobe.
Adobe, ADBE.
I'd have to advise against that.
Yeah, that was an avoid. Bob in Holland, Ohio wants to know about Coca-Cola. It's KO. And oh, by the way, I have to disclose, it's in my portfolio.
Well, I love Coke. It's come down a lot. A lot of these, what I call consumer non-durable type stocks, have struggled. The value names are not doing really well. And I think this thing down at $60 is kind of a steal. It's had some short sellers in it. It's not incredibly overvalued. I heard the CEO the other week. He was speaking from Davos, Switzerland, and he was pretty positive on the company. And so I'm a fan. Earnings in the next year are supposed to go from 241 to 295. And if we get any dollar weakness, the dollar's just been incredibly strong. Dollar weakness would help the stock out a lot. So I'm a solid buy on Coca-Cola.
And so Coca-Cola, ticker KO. Sometimes a burp is a good thing. That's a buy. And last, for Dave in Jacksonville, Florida, it's NASDAQ, NDAQ.
NDAQ is a pretty interesting name as we enter this year because this could be a big year for IPOs. We really haven't seen it. We just had Smithfield Foods, symbol SFD, go public the other day. NASDAQ earnings were positive. They beat. No one's short that stock, which is actually good because It just means they've looked at it, and even though it's gone up a bunch, it's gone in the last year from 55 up to 80. But I think there's a lot more upside, especially if the IPO market really gets going. And if tech stays strong, I expect the NASDAQ could have a pretty good year. And they have a pretty strong CEO in Dina Friedman. She does a really good job. So I would give a thumbs up to NASDAQ. That might have a really, really nice return if this IPO market comes back, which it hasn't in the last couple of years.
Don't worry if the price starts going up. Just keep buying.
And so we finish on a high note. That's a buy on NDAQ NASDAQ. And speaking of good buys, well, we've gotten to where I have to say our goodbyes to Geoff Garbacz. But Geoff, this was really good. Thanks so much for joining me on the show to talk about it all. We'll talk to you again down the line.
Thanks, Chuck. Have a great one. Bye-bye.